Hello, Douglas, and welcome to Refashion Podcast. It's my pleasure to have you here today. And together with Douglas, we will be talking about a very important topic, and that is sustainable investments. And in particular, we will be talking about the importance of ESG ratings in financial investments. So, Douglas, once again, thank you so much for finding time for me. And could you just briefly, in your own words, introduce yourself?
Well, hello first. Sure. My name is Doug Lopez. I'm a senior partner portfolio manager at a firm called Aristotle Credit Partners. We're based out in California in the US. My role here is to manage portfolios for clients in various mandates. We focus on corporate credit investments. And one of the areas that we several years ago began more fully incorporating into our analysis was ESG as a way to make better investment decisions in the portfolio. So that's kind of my role. And I guess the relevance to the call today is that incorporation.
Absolutely. So, for those who are not familiar with the topic, what is ESG investing?
Yeah, so ESG, kind of breaking it down, environmental, social, governance issues. It's what it is taking these factors into consideration and making investments on top of and in addition to traditional financial metrics that and most investors have been following for generations in terms of how they make investments. So ESG is environmental issues, such as energy use, greenhouse gas emissions, water consumption, hazardous waste generation. The social aspect of the S is social. That really has to do more with analyzing and assessing the workplace environment, such as workforce accidents, turnover of employees, workforce diversity, compensation, labor management relations, human rights considerations. And then the governance side of the G stands for governance, and that's really has to do with things such as diversity and the size of the board, internal versus external board members, other types of governance considerations, executive compensation, reporting and disclosure, things like that. So these ESG metrics, a lot of those, traditional financial investment, you would take these into consideration perhaps in the process of, traditional analysis. But what ESG investing is really a greater focus, a greater lens in this area, and more disclosure, and then using that to make better investment decisions.
Talking about that disclosure, how easy is it to access that data? Is it publicly available?
So it's becoming more publicly available. Right now, a lot of it is through paid third-party subscriptions, but there's becoming more free, publicly available information for investors such as ourselves. We rely on, that paid subscription with different services, along with what's also available publicly, and then what we come up with ourselves. So, it's a little hard to get. That's probably one of the bigger frustrations within ESG investing these days is actual data disclosure by companies. In Europe, it's more mandated that certain metrics are disclosed for ESG. In the US, there really aren't mandates at the government level to have those disclosures, but that I would expect to see more of that going forward as it becomes more visible with the government here in the US and overseas, and obviously Europe's the leader there. Asia is also having more disclosures. Over time, I would expect to see more disclosure and more publicly available and for everybody.
I will hope so too, as well. And I was wondering if you are rating the company on the individual basis, or is it peer-to-peer analysis?
Yeah, it's both. So we do our analysis on ESG very similar to what we do on traditional, financial analysis that we perform on companies. So we're looking at it on an absolute basis, but we're also comparing it to its peers. I think within ESG, that peer comparison is even more important because there's certain industries that, because of the, for lack of a better word, the neighborhood they reside in, say the energy industry, they're always going to look dirtier and have more problems than perhaps a company and in the technology industry where maybe they don't have enough, they just don't encounter as many environmental issues in their daily operating performance. So it's very important, to compare them to the peers in the industry, because we want to not exclude companies. We are PRI signatories, that we've been there signatories for several years. And we really believe more in the aspect of ESG analysis to enhance the investment decision, to make better decisions. It's not about excluding industries or excluding companies. It's about inclusion and then reinforcing to make them better, better actors within ESG metrics, the environment side, the social, and the governance. So yeah, that's kind of how we look at it. But it's really the peer analysis is obviously more important within ESG because of some of the issues that lie within certain industries that you just can't get away from as part of the regular performance.
Yes, absolutely. And is that also correct to say that different industries or different companies would have different importance areas?
Exactly. That's a great point. So in different industries, one of the things we do is our research team will cover, each analyst covers different industries, but it's very important for the analyst, the portfolio manager, and overall investment community to understand, within different industries, there's different priorities and key metrics you want to look at. So say in technology, you're looking perhaps, not so much environmental is a big issue, and people are becoming more aware of the amount of power used and power generation required, and where that power generation is coming from, and perhaps data centers and the phenomena of the cryptocurrencies, things like that in technology. But we were focusing maybe more there with those companies on the data security side. In the financial industry, data security is also extremely important. Whereas when you move over towards, obviously energy, you're looking at environmental issues as kind of the bigger focus. Within the textiles apparel area, you're looking at the supply chain and the labor issues, perhaps more so there, and in manufacturing, more on the social kind of working environment side. So there are different focuses in different industries, although you're looking at all the metrics across every industry. Certain industries you want to focus more in one area or the other, because that's going to really be the key differentiator of who you want to invest in, and has the best behaviors and continues to improve their behaviors in those areas and policies.
Absolutely. And you already briefly mentioned that there are third-party suppliers of such data, but whom would you say are the most reliable partners in terms of sharing such ESG data?
Yeah, so and for the sake of not being an advertisement for one given company, what I would do is I would try to put them into categories for you. Is that there are some very big providers out there. They're pretty well known, but it's come really from two different directions, right? So there are some data providers out there that are just massive companies that provide financial data in all different aspects, whether it's ESG or just financial data, whether it's shareholder votes, proxies, things like that. So there's companies that focus on that have made a push to get into the ESG side. Those are very good providers, and they're really, what their strength it really is actually on the distribution, how they manage the data, sort it so that you can actually get it in a usable way to sort through thousands of companies and do screens and analysis. And then there's the other direction that's come more from organizations that had their birth within sustainability. These organizations were initially talking about sustainability issues and policy issues, and had agendas they were pushing, whether it was emissions or labor or things like that, that then got into the data side and started becoming data distributors. So we kind of prefer the genesis of the companies coming more from the ESG side. We find a little bit maybe a little bit better qualitative analysis of that data with that background. But both of them provide and there's a number of vendors out there, and an increasing number of vendors in the third party area that provide very good data. The differentiation is really more on the actual analysis of that data and what they kind of add on and layer on top of that, and that's I think when you want to look at it in a data provider. So it's kind of similar to what the history of financial analysis and financial metrics. Initially it was just can you get the data, and then it became what can you do with the data? What can you do on top of that to give us a better read so that we can make better decisions in our portfolios? It's kind of following the same path within ESG data.
Okay, I understand. And I was thinking as well, there is a bit of a bias towards ESG ratings from what I have heard, that it is basically picking up the phone, calling a client, and filling out the survey, just ticking the boxes and then giving a rating on that. Would you
Right.
say that's a valid bias, or is it just a rumor?
So there are a lot of, I guess they would call greenwashing out there right now in terms of investors or providers that are really kind of just, like you said, checking a box, grabbing data, and making decisions just off of kind of unanalyzed data, which is really dangerous in ESG right now because there's a lot of companies that don't report much data at all. In the US, especially the companies that we talk to, a lot of companies don't really understand exactly what they're supposed to be reporting because there's not a lot of standardization, right, in terms of that, similar to, versus what you have in financial metrics. So, and hence at this point, the data is something you want to look at, but it's really about the engagement and the follow-up and the discussion and the dialogue and asking about the policies in place in each company that gives you as an investor or even somebody who just analyzing outside of the investment community, on suppliers or somebody they want to do business with or have involved in their business. It's really those discussions that lead to the analytical decisions that I think, are leading to the correct decisions. The data is really scratching the surface, and a lot of it's because it's very imperfect data today. It's sometimes unanalyzable. What we found with some smaller companies is there's a bias towards big companies on the ratings, because the big companies have enough money to hire full-time staff to gather the data and statistics and compile it in a form that the data collectors want to see, and that investors want to see. And so they get that boost in their rating because they're supplying all the data, whereas smaller companies on limited budgets don't have the manpower or the budget to have a full-time staff person doing that or have full-time measurements done inside of with the GHG and things like that inside of the organizations. And so they get penalized for that. And so to us, those are the opportunities that we want to look for, is to identify those types of companies, similar to financial investments, where you identify the companies that are underfollowed, perhaps don't get the credit they should for what they're doing, for one reason or another, and then encourage them, participate in them to improve over time, disclose more data. And as they do that, their ratings will go up and the markets will recognize that. And I think the investment community will recognize that, and they get a better return on that investment from the acceptance side, and the number of investors broadens out. So yeah, there's definitely a bias towards bigger companies, similar to credit ratings and similar to financial ratings by a lot of different organizations. It's just because it's easier to rate those, but that's not necessarily the best way to do it.
Yeah, absolutely. And I think you have already mentioned hints towards historic trend, that it has not been the same 30 years ago,
Yeah.
40 years ago. So could you briefly comment on the whole change? Why is ESG important? How did it become an important aspect?
So, that's a great question. I've been investing for about 30 years. I hate to say it, but I'm getting up there. In terms of the history, I've always had clients, we've had separate accounts that we've been managing for pretty much most of my career, and that involved either, faith-based organizations or healthcare organizations, or, foundations, endowments with universities and such, or causes that had restrictions on types of companies that perhaps they wanted to own. So if you go way back, 20 plus years ago, it was really just about, ESG didn't exist. It was really what they call, more SRI investing, which is, socially responsible investing. But back then that was defined as identify a list of companies you can invest in, and that's about it. And then give it to the manager, and they don't buy those, but they do whatever else in the rest of the portfolio they want to do, which in some ways could have actually be counteracting what you were doing in the negative screen. So you could be buying companies that were easily as bad or worse, but they just didn't happen to make it onto the list. So in the early days, there was usually an agenda or an item that was trying to be met. So they came up with a screen, whether it was apartheid in South Africa, and that went on for, unfortunately, way too long. And a lot of investors started screening that out, and it actually led to, I think, was one of the reasons that things started to change. Hopefully, that's kind of the old days. As it over time, what's happened, and it's really just been a phenomenon in the investment world in the last less than a decade, has been that you started to get where more data is being reported on some of these metrics I talked to you about earlier in ESG. And really in the last 5 years, I would say you started to get more participation. And even today, it's still in the infancy. But what has become more in the last several years is more of a full picture in terms of understanding the company, 360 degrees, as opposed to just having a list of what you can't buy. It's trying to make an impact in the rest of the portfolio, in the spirit of what those investors want to see, the types of companies they want to see. So as investors have become more aware of, some of the issues as they've been published, in various ways, basically, as they become more aware, they say to managers, we want to see these included in the decisions. We're not going to give you a list, but the idea is that you take those factors into consideration when you're buying investments in our portfolio. So that's really where the world has come. And so there's still investors with very specific agenda items. For some investors in ESG, and this is important, really all they really care about is the environmental side. It's all about emissions, right? It's about the climate change, and that's totally understandable. We view it, we think that you should take into consideration all the factors. We run some investment portfolios that screen out all fossil fuel companies. So that still takes place today with these negative screens. Other negative screens, perhaps from faith-based organizations, screen out, certain healthcare issues that they don't agree with, or, there's always, controversial weapons is something that's pretty standard across the board, but there's some that, companies that kind of are investors that raise the bar there. So there's still that negative screen aspect, but the difference between now and when I got in the business is that it's really more of a comprehensive analysis of some of these factors we talked about, and incorporating that and having dialogue with companies about that. That's really where the evolution is, in terms of this, and actually making better financial decisions. And there's a lot of reasons I think, by incorporating ESG, you can definitely make better financial decisions, because at the end of the day, sustainability is a key metric in looking at a sustainable business model of a company that you would really find attractive to invest in.
And on that regards, I come from a business background, from the business school, and what we have been taught at university was the whole purpose of the firm is to maximize shareholders' value. So would you say that the shareholders are also more interested in ESG incorporation and sustainability strategy these days?
Definitely. I think they go hand in hand. And that's one of the big misunderstandings is starting to go away in the market, is that they're different, is that maximizing shareholder value and ESG are two entirely separate things. And some people even think, they may even be counteractive or countering each other, and we totally disagree with that. We think that to build a sustainable business model, which at the end of the day, a sustainable business model is the kind of investments you want to look at that are going to perform over time for your clients. If you're going to look at a company that has that, assessing the environmental, social governance issues in detail as part of that analysis, we think is key to identifying those companies that have that sustainable business model. And that's just on a standard operating basis, examples being, the social, the workplace environment. If you have a safe work and a healthy workplace environment that's got safety, good compensation, treats the employees well with benefits, all these things that everybody wants to see in their jobs, you're going to end up with less turnover. You're going to end up with better employees than your competitors. And you're going to have, therefore, probably a more successful business. Environmental issues, same thing. If you do things that are really bad, I have a number of examples, whether it's chemical companies or energy guys with flaring. It's just a number of examples. If you're doing that and then it gets into the community and you're harming the community, you're going to eventually have pushback, and it's going to lead to litigation. It's going to lead to people not buying any of your products. All these things that have a bad financial result, right? At the end of the day, maybe not in the short term. And there's always examples of companies that do pretty heinous things and make a lot of money in the short run. And if that's the way you want to invest, then I think that's too bad. We don't believe in that. And I think most investors don't believe in that. And they want to buy good businesses they can own over a long time and see them grow. And we think you have to have a sustainable business model that includes these factors in it to be successful. So we think they go hand in hand at the end of the day in terms of financial success and success as an ESG provider. And going forward, I would just say it's going to get even more clear that these work hand in hand, because I think, with not my generation is getting a clue about it, but your generation is I think really the driver of the future. And there's a lot of push and a lot of desire to buy your products from companies that you agree with in terms of their standards that they have internally, and how they manage their employees, how they relate to the community, the environment. I think so. I think I think consumer demand is going to is just be another lever that's going to result in, probably better profitability, better success for those companies that are doing things what we say is the right way.
And who would you say are the companies or industries which are rated the highest on ESG ratings?
Yeah, that's a great question, because a lot of people think that these ones are easy to buy and these ones are easy to not buy. And I think that's the initial days of ESG investing several years ago was like, oh, you don't buy any energy companies and buy all the tech companies. And it was kind of a no-brainer, And I think as the market has evolved, we realize is that, energy companies aren't going away, tech companies are here to stay. But the bottom line is that there's good and bad companies in all those industries. Now, obviously, energy with emissions and the environment is under the gun on a lot of things. But the bottom line is we all use energy every day. It's not going away. And so what we want to do is we want to make, encourage those companies to find, more environmentally, safe ways and environmentally conscious ways of generating that energy. And I think what you've seen, especially in the last few years, even the last 2 or 3 years, is energy companies coming out with bigger commitments. So the answer is that I wouldn't try to say there's one industry is better than another. There are some industries that I would say don't really have a lot of redeemable features that are pretty easily to avoid. Things that if they went away tomorrow, probably the world would be a better place. Tobacco, some other areas, just some of the controversial weaponry is just, the world's a better place with it gone. And there's some other areas, some of the heavy emissions and super damaging, energy kind of extraction techniques could be done away, and mining techniques. But that doesn't mean you get rid of those industries. You're trying to find the companies that are finding cleaner ways to do these things that provide the materials we use every day. But like I said, technology was always considered a no-brainer, not always, but in some people's minds it was. And I think there's a lot of concerns, and you're seeing those in today in terms of a lot of regulators looking at data security, data privacy, all these issues that are, perhaps even more damaging or as damaging as some of the other issues that people have put at the top of the scale. So I think as the world kind of evolves and we get more knowledgeable, I think it's going to really be about identifying in all industries the best players, and you're going to be able to differentiate as opposed to this is a good industry, that's a bad industry.
And would you say that any sustainability strategies or United Nations SDGs agenda within the company, or being a B Corp, does that boost the ESG rating as well, or does it have no impact at all?
Yeah, it definitely does. Those are really hard. Those metrics are sometimes very hard to measure, like quantitatively. It's really more qualitative assessment. We look at it as really kind of to input in our analysis to identify companies that are really visibly working counter to those agenda items within SDGs, right? So, are they suppressing workers' rights and gender equality and and water, clean water and the environment? Are there things that we've noticed are identified that are counter to those agenda items? And if so, we're going to want to push away from those companies. But I think there's a consistency. You'll see that also show up in the data of the scores they're getting, and the policies they have in the companies to address those areas. But really within SDGs, you're really looking at policies within the company that align with those and kind of doing that qualitative analysis. So they are very important. Some of them are very, the SDGs are very long term, and some of them don't apply, to all businesses, to any significant degree. But it's something that within, it's kind of like the industries, in your industries, knowing the SDGs and kind of where you want to look at those more so in one industry or one kind of company versus another, maybe where it operates would lend itself more towards one SDG or another as a focus item. There are definitely things to incorporate and make for a better ESG investment.
And in terms of the ESG rating, again, is this a static number, or do you usually review the score?
Yeah, so that's really important. Our viewpoint is that there's the data analysis, there's the data assessment, there's the engagement with the company to question the data, to probe for data that isn't there as we kind of go through our analysis. And then that final step is the monitoring, just like with a company's financial metrics, the leverage, the cash flow, things like that. You want to monitor every quarter and see how they progress, right? So you want to go in and talk to them. You want to figure out and assess, kind of where the strengths are, the weaknesses are within ESG metrics. And then you want to have that conversation with them. And then you want to ask them, what policies do you have in place, or what is your plan to improve A, B, and C? And then you want to follow up with them, maybe 6 months down the road, maybe a year down the road. You want to reanalyze that company and you want to see progress. So it's not always buying the companies that do everything perfectly within scores today in terms of disclosing everything. And because that isn't really what I think this is about. This is about finding companies and encouraging them through investments in their companies, whether it's the bonds or the stocks, to encourage them to continue to improve. So you want to see a policy in place. You want to see goals. No company does most of these things perfectly at all. And so they can all improve. So it's all about the trend. You want to buy companies that are improving in trend, because that's where you get the biggest impact. Just like buying a company early days of its operating, in terms of operations, you want to buy the ones early on that are small, but you could see that trajectory of improvement. Those are the best investments, right? So it's the same with ESG in many ways. Unfortunately, the big guys who report all the data to get the high ratings, some people view that as the way to make ESG investments only. It's just the top rated companies. And we're really more about identifying those that are going to improve the most. Some of them are going to be high rated. Some are going to be a little bit lower rated by the third party services, but it's about that trend of improvement, because that's where you really make the most impact and can do the best for your clients.
Absolutely. Since my podcast is focused a lot about fashion, I cannot ask you this question. How do fashion companies perform in terms of ESG ratings?
Well, I'm probably like the worst person in the world to ask about fashion, but you can ask anybody in my family. I'm a really good ESG fashion client, because I don't rarely buy anything new. I wait for fashion to come back, stuff that I bought many years ago. But yeah, fashion is something that in the whole apparel industry and textile industry is something that we do invest in. It's one of the investable industries that we go into. And the bottom line is it has become a little bit more in the limelight of late. Obviously, we've had some human rights, a lot of more disclosures of human rights issues that are violations taking place in manufacturing facilities, or where the materials are being sourced and how they're being sourced. So it's definitely something that, we invest in. It's something that, we think you can see companies that differentiate themselves. We don't have a lot of those companies in our market, in the credit markets. It's a little bit more equity financed than debt. So I don't have a great read on all the different players out there as well as you would. But it's something that we do look at when we're assessing those companies. We're looking at the sourcing. This is, that's an industry where you're looking more at the labor side, the sourcing of materials, but you're also looking at the environmental issues, obviously with the water treatment and, for dyeing the materials, and is the chemicals being used and how that's all taking place. So those are things that we're looking at in that industry. And there are companies that I think differentiate themselves.
All right. Thanks for your answer. I think
Mhm.
that's very interesting to think about. We all know that the fashion industry is one of the most polluting industries in the world, and it also doesn't have the biggest profit margins either. Yet we have really huge players which claim to have a sustainability agenda and driving the change. But we will see how well will that come into the reality. But in terms
Mhm.
of just driving the whole change and the transformation towards more sustainable future, now there is such awareness around that, and every company, as you mentioned as well, they try to implement certain initiatives. What do you think is needed to ensure that the future generations have enough resources to sustain themselves and further develop?
Well, I mean, I think you need to become more circular in kind of the usage. Each industry needs to become more circular and not create so much waste. That's obviously in terms of the future and having the natural resources that we need. We got to stop throwing many things away. Fashion. Obviously, the cheap clothes that you get that are meant to have a lifespan of six months, and then they kind of either fall apart or go out of fashion. I don't know. So, I mean, we want to basically become more sustainable in what we're buying, whether it's fashion or it's the products we're buying, the containers that we're packing in the packaging of the material, the food we're buying, or the other consumer products. So, I mean, that's creating more circularity in each of the industries in terms of using the raw materials that cycle through, and not ending up in a dump somewhere, or landfill. I think that's obviously extremely important, and I do think there is more of a push there. Also, in sourcing the materials, to more sustainable materials, moving away from, maybe fossil fuel, sourced materials, and less plastics maybe, and more biodegradable materials that we're sourcing, whether it's utensils or packaging or things like that. These are all super important things, in terms of conserving what we have, in terms of the resources that we have. And then we can go on and on and on of examples, but taking better care of how we're sourcing things that we eat, and where it's coming from, with the waste involved in that, the chemicals used in that process, or whether it's and then just the somewhat abusive nature sometimes of gathering things to eat, in terms of everything else around it. We have to really address that in terms of how we're sourcing our food also. So these are all super important things, and the list goes on and on and on.
And would you say that people are getting more aware of those issues and they start to demand a change as well?
Yeah, for sure. Yes, people are demanding. You're seeing that show up in some consumer products. There's a little bit of we have a saying here in the U.S. called "smoke and mirrors." So there's a little bit of putting a label on something that says sustainable, and basically the guys that sold the product paid them off to get the label on there, to make it look like it was sustainable. But the reality is there's not the verification in there that really shows that the methodologies used to source, whether it's food or something else, is sustainable. So we need better checks and balances, more regulation, I think, in some of those areas for sure. Um, More transparency, and we just need people to continue to flush out, where the inaccuracies are in terms of how things are being sourced. So yeah, I mean, I think there's a greater awareness. Along with that awareness is more information, and I think that's the first step, right? Is better information so that people can make better decisions.
Yeah, absolutely. And, talking about the recent changes in the whole world, how do you think the corona pandemic has changed people's attitude towards sustainable investments?
I think what it really has done, and something we've focused on and have increased the focus on in the last year, has been just the treatment of the workforce. So I think the coronavirus has been a disaster for so many people, and so damaging to so many lives and careers and everything else. So, and the bottom line is, when you're working, how companies have adapted to take into consideration difficulties with their employees. You know, for the manufacturing type of industries, how safe have they made those environments? Because they've had to continue to produce through this entire pandemic. So how have they treated their employees in that environment? Some have done a great job and some haven't, so that's something that the pandemic is, I think, maybe brought more to light. I'd say, maybe this, like I said, the social versus, the environmental side is kind of continued. It kind of had a lot of momentum before, but I'd say more of the work environment has really gotten pushed a little bit more up in terms of people's visibility and the stories have come out on how companies have treated their employees in this environment, whether it's the frontline workers in the hospitals, the grocery store, retail, or the behind the scenes and the production of food sources, and the treatment of those workers, all these things, or how they've dealt with the remote workforce. Have they been demanding people to do things they aren't comfortable with before they're comfortable with it, or have they been much more flexible and understanding? I think that, to me, is probably the biggest thing in the pandemic that has really come out and versus pre-pandemic in terms of maybe one of the areas of focus.
I can only agree to you. And I think in the fashion industry, there was a huge pay up movement where there were a lot of stores closed, and there were a lot of suppliers who were not paid for their orders. So there was much more information disclosed around the issues in that regards.
Right.
And I think this is very important. And I think we touched upon the labor factor, the social part through our talk today a lot. And I think one misconception that people might have had prior to our conversation, that social part would be of the ESG would be kind of constituting towards philanthropic business. And that is not really true, right? And because we focus more on the labor condition and the well-being of the employees.
Well, corporate philanthropy is part of that. It's one factor, right? You can be very philanthropic and yet treat your employees very poorly, right? So it's all, like I said, it's really about that 360. It's like all assessing all these items. But I'd say definitely, like I said, the more important movement in the last year in terms of information flow and really fleshing out the good and the bad actors has been on the labor side and the treatment of labor, for sure. And how they've worked with the community and how they chipped in. Have they come in and been a little more philanthropic, but also in terms of providing services and other resources for their local communities. That's it's definitely important, for sure. So that's not to say we exclude that, and that's not important. It's just I think that's something that a lot of companies had set in place already. Some improved it, but really it was more fleshing out the labor side and the treatment of that is really brought to light.
And then with the increased amount of information and transparency, people started to become more aware of how they want to invest their money, right? Hasn't there been a change in individuals requesting their portfolio managers to choose more sustainable investments for them?
Yeah, like everything else, some people have slapped labels on products that they know people want to see, and then they bought them. And that's been part of what's been going on. But there are some really great products out there that different managers are running, and investors are looking for those. So it's our job as investment management organization to get the word out on how we do it and how that might be different. But we have seen a lot more demand for these ESG integrated products and the assessments that go along with that. With investors that want to see those considerations taken into place. And like I said, it doesn't mean it has to be a hard screen against industries or companies. Sometimes that does happen, but a lot of investors say, use your discretion, but take these things into consideration, please, with what you're doing in our portfolio. And in the process of several years of really doing our homework on this area and working more and more and learning, we've really come to see how it really dovetails extremely well with the types of companies that we prefer to invest in and that we think make the best investments and long-term investments. So for those clients that are looking for a manager or and other managers who do the same thing, this assessment, I think that is definitely increased in terms of the demand for products. But like I said, there's also some clients that you've seen a lot more interest in, fossil fuel free strategies where they're just like, I just want to exclude all of that out of my portfolio. I believe that we shouldn't be investing in those companies, and we understand that perspective also. But the visibility is definitely higher as the younger generations get more involved in the markets, as some of the very successful ultra wealthy start thinking more about the future of the world as opposed to the wealth accumulation, and where that's going. As organizations get pressure, whether it's a university getting pressure from its students on what they're doing with the foundation and endowment, or it's a constituency's voters in a constituency going to the local government and talking about what's in their pension fund. These have all increased in the last decade, and I think even the last 5 years we've seen the biggest push in that direction.
And would you say that the biggest push you get are from the younger generation, the millennials?
Well, I don't know if I'd say maybe at the genesis of how this is moving, that's true. When you're working in the financial markets we work with mostly bigger clients and wealthier clients and institutions. It's hard to see through to the younger generation because their wealth is not quite there yet. But it's definitely coming. They're definitely very loud. That visibility and being very vocal is influencing, the older guys like us to really take note that this, and then think about it, and listen to, these young adults that have a lot of great thoughts, and really respect that and take it into consideration. And in doing so, it's really changing the attitude, I think, of an increasing amount of people that do have the financial wherewithal to have a bigger impact, right? So unfortunately, in our world of investments, the size of the wealth has a bigger, the more wealth you have, the bigger influence you have, or the bigger your pension fund, the more influence you have, right? But if what's driving that thought process of the people with that money, or the pension funds or the foundations and endowments, is coming from a very vocal message being sent from millennials, I do think that is true. And that is having a definite influence. Kind of punching above your weight is kind of another cliche.
I see. Just to step out a little bit of the ESG discussion, what would be your general advice to the younger generation in terms of investing their money wisely?
Yeah, so you step aside and kind of investments 101. There's a lot of very topical types of investments out there right now where you're seeing huge percentage returns. For me, as a long-term investor, I think it's just really with the young, it's really about, you got to be diversified. You're young, so you can take risk, but you got to think about, invest as much or in an area with a lot of volatility as you can lose, because just for anything that goes up 600%, it can go down to almost nothing. So, there's no free, there's no free lunch out there, right? So if it can go up a lot, it can go down a lot. It's really a risky bet. It just so happens the financial environment right now is rewarding investors to take a lot of risk, and the government's kind of sponsoring some of it, unfortunately. But the bottom line is, I would recommend diversity. Take a more holistic approach, and don't underestimate your common sense. If it doesn't make sense, it probably doesn't make sense. If logically you just say this, I don't get why this is happening, then it probably shouldn't be. And it's something that you shouldn't get too involved in. So common sense, diversification, holistic approach. Find things that you really find interest in, things that you really like. Invest along those ways. I think is also, and then don't, and I think ESG inclusion. Think about sustainability, because that's the future. A lot of things, the biggest trends in the markets right now are towards these more sustainable agenda items. So definitely incorporate that into what you're thinking. You don't want to just only do that, in the most extreme versions. You want to, but try to find some companies that are earlier stages and incorporate that in. But diversification and common sense, I think, are the two, pretty basic ways of investing.
Thank you so much for your advice. And just before we wrap up our talk, I would really like to do one last thing with you, which is 5 short sentences that you have to finish. So I would take them one by one, and you would just finish it on the go. Is that okay?
Yeah, sounds great.
All right, awesome. So, first one, to me, sustainability is
Balance. You got to balance the needs of society with the health of the environment, the workplace, etc.
that's a great one. Second, one thing I would like to see more of in the world is
Communication, interaction, because all that leads to understanding. It leads to respect, and the world's a better place.
does that also lead to more data out there that we so need?
It also leads to that. All information is good information, whether you like it or not.
All right. For a complete beginner in the sustainability area, I would suggest to start off with
Common sense.
okay, that's a good one. And the first one, every sustainable business
Should start somewhere today in terms of improving your sustainability and incorporation of ESG metrics. Don't be afraid to start.
and probably reach out for advice and
Reach out for advice. And the reason I say and I'm going to give you more than one sentence, but the reason that I say that is because we've talked to a lot of companies, and there's a lot of confusion out there on what ESG is. What do investors want to see? What do our constituents want to see? What do the consumers want to see from us? What can we? And then they freeze and they don't do anything because they think it has to be perfect, and they think it has to be full disclosure. And I think that's why I say just start somewhere, start communicating today, and whatever you have is fine. Get it out there. Try to put it in a metric that people can at least be aware of, and then talk about how you're going to improve that. So start today, and then put out a plan to grow going forward in terms of building a sustainable business. But don't be afraid to start.
all right. And then the last statement, in 2 to 3 years, I see financial investment industry.
I do see the financial industry becoming much more aware and informed on ESG and how it can actually help you make better investments in your portfolio and why. So, yeah, I think that's what I see.
Awesome. Douglas, thank you so much for your time and sharing all your knowledge and expertise with us. I had a really great time, and I think I come out from this conversation much wiser than before.
I do appreciate your time, and I think these were all great questions, and hopefully people find the information useful.